Hi everyone, this is the 12th of Feb 2020. The Nifty's managed to close up for the last 2 days, but the way this week has actually started is that we started with a gap up and then moved a little lower yesterday and then came back up today. So when we gapped up on Monday, we actually left behind a small little zone which was just below the 12,100 mark, and yesterday's pullback essentially ended up taking support on that. Now, of course, this gap is only on hourly charts. It's not significant on the daily charts because there's no clear visible gap up, and so it was essentially an intraday support that we ended up taking yesterday, and then from there we continued to move higher. Now we also made a higher high, which means we went past the high that we've made in the first rally, first post-budget rally, and since we've done that, the initial indication could be that you've started another move higher. Now the people would argue otherwise. If you're really looking for what we call Elliott wave wise and expanded flat, then you'd probably wait for the 138% mark to get taken out, which is closer to 12,230. So that ends up being, I think, the key level beyond which things would really fly. And the other indication that we got over the last couple of days, and now everyone started watching week to week expiration data. You can also look at the monthly options chain spread. But when you look at the weekly spread, then you actually saw support coming in at around 12,000. I think on most of the series, you're seeing 12,000 as a support into the month end. But what really changed today was that till yesterday you had resistance near the 12,200 mark. So a lot of call options open over there, which were not looking like you'd surpass that resistance into tomorrow. But today there was a complete shift, which means that a lot of put buying or selling both ended up happening at the 12,200 strike. And what that ends up meaning is that now all of a sudden you have support at this level. And so this is how this data changes. You can't really use it as an all and final, but it does just give you those short-term levels from where swings can happen. And so I really prefer looking at the overall trend of the market, but it just gives you some kind of sentimental support, I think, in terms of watching what the levels are doing, in keeping in mind the overall picture that you have of the market from a trend reading and a momentum perspective. So this change, at least for the short-term traders, indicates that possibly you'll not only hold 12,200, but you'll probably attempt to break higher. But you simultaneously have a lot of call options in 12,300. So will it only end up being a 100-point range that we're talking about for tomorrow? So you have both, because after all, this is a weekly options expiration which ends tomorrow, and then everybody's just betting on each side of this trade. And maybe this happens every week because it's essentially like buying a lottery ticket on both sides and hoping that you get a big move, and if not, then everybody loses anyway. So it might not be as significant as it seems one day before expiration. Now that said, you do have a larger trend developing in global markets. You've seen the US markets already make new highs, and I posted this chart in the IC mornings report this morning from the DAX index, the German index, which made a higher high, and my sense is that it's starting a wave 3 of 3 on a slightly larger long-term chart, because it's pulled back. I think when you were seeing the Asian pullback on the back of the coronavirus fears, and that pullback would probably have been after a 5-wave advance. For a while I doubted whether DAX is also 5. You could see that in many other charts, but not so clearly here. But if you take the 4th wave as a running, not even running, I should say, basically as a flat pattern, which is a 335 kind of a correction in a sideways channel, then it's just slightly upward slanted, which is why I use the word running. And then you can you can actually start a larger third wave on the way up. And so maybe that's what has happened. It definitely would look like on a slightly longer term chart if you go to monthly or quarterly. So in a very long term basis, you are in the 5th wave for the DAX, and within that wave 3 of 3 may be just starting, which could be a pretty powerful leg. And so you'd really want news and data coming out of Germany or Europe to actually start changing at this stage as this is happening, because most of the data that has come out so far, I think even into December, and to some extent, I think, yes, I should say only December, not even January, because most recently, I think in my last update, I showed you PMI numbers for the first time after long across Europe and many places popped up back above the 50 mark, which means some kind of growth coming back, but it's only 1 month data point, so it's too early to say. But if the rally has to continue, like I'm saying 3 of 3, then probably you need to get more support from data on that front. The other big thing which is happening and which has changed my opinion is that on interest rates, because for a long time I thought the rates as far as the bond yields for India are concerned would end up spiking higher as and when you face the depth of the winter crisis. Now you had the setup for that in the second or third quarter of the previous year, that is 2019, when the NBFC and post ILFS cases were at their highest, and also the fears related to that in terms of bond spreads were at their highest. But that did not end up happening. Bond yields did move up, but then started to fall all over again. So the triangle that I was looking at probably is complete. So I would have to think that you've not touched the top end of the line, which was closer to 9%. You just went to around 8.3 and then started to fall from there. Even at that point of time, you could have held on to that till you really see a 5-wave decline. And now the most recent decline in yields, which is a rally in bonds, is occurring and looking like a 5th wave. And so this looks like something bigger on the way down having started. And you can see that in the measures that the RBI has been taking, not just the rate cuts it did last year, which it paused for a while. And clearly they were saying that the trajectory is going to be for lower yields, but they paused waiting for the government to come out with this year's budget, and so they could have the numbers, and also waiting for inflation to tick off, because there was a slight spike on the back of food inflation in the last quarter of this year. Now all of that done, the RBI did not really cut rates after these events, but what it has ended up doing is finding some other way to continue pushing liquidity into the system. So liquidity remains the elephant in the room, I think, not just in India but in the US as well, and which is why bond yields are not only going on down in India but they're also going down in the US. And a similar thing has happened there, where we looked at the big declines in bonds in 2018, and even prior to that the one which occurred in 2014. Both looked like they were major declines, because the 10-year actually peaked in 2014, and the long bond, the 30-year, only peaked much later in 16-17, from where you got a major decline. And that's when the Fed was looking at quantitative tightening and pulling back on its QE program. And so when it was doing all that, slowly bonds rolled over and you started to see yields spike. But from last year, the rally in bonds, initially it was only 3 waves, so I was wondering whether it's counter trend. But recently it formed a triangle in the last quarter of 2019, and then we've actually rallied again from there, making the entire setup a 5-wave advance. So what does that mean? That means that you've actually changed course as far as bond yields are concerned. Even for the US, they are in a declining trend. Now, of course, after a 5-wave advance, you're going to see some pull off, and usually as equities continue to rise, bond prices do go the other way. So I think there'll be some pullback in US bond prices, not maybe immediately, but after a while, because they, like I said, they're in the 5th wave of this move. But after a 5-wave and a pullback, what you're likely to see is potentially another decline in US bond yield. So that's the big takeaway. The change in structure is that you've had a long-term 3-wave decline in bond prices, which is rise in yields between 2016 and 17, probably into 18. And now you're seeing the reverse of that, which is falling bond yields and rising bond prices, and probably that trend is not over on a long-term basis. You might complete one leg and pull back, but there may be more left. So this shift towards lower yields from what was looking like a higher yields environment is I think the big change that I'm seeing in both of these markets that I'll continue to track. Now, one of the other data points that are actually put out a couple of times recently, and even it was out in the media, is that FIs continue to remain short. These short positions were built up in the last week or 10 days into the budget, which is when prior to which for almost 2 months their long short positions were almost near zero. So there was fluctuating between 20,000 to plus or minus 20,000 contracts in the net in the index futures. So they were not significantly long or short, and then suddenly prior to the budget they went to the short side and just kept adding, and eventually it built up to almost 100,000 contracts. Now you're close to plus or minus 110,000 contracts. Now many of the previous peaks in the data have been near 125,000, and the highest we've seen is 145,000. So we've not reached that number, but we are still pretty close to that number, and you'd want to actually see this number unwind and go from the short side to the long side before I say that you're at a significant or meaningful peak. But right now it continues to indicate bearish sentiment or an overly bearish sentiment, which is not typically what you see at market highs. more often than not you see at market lows. So they've continued to do this. They did it in August, September. They unwound that entire short position, and now they've added it back on the fears of maybe a weakening economy, the budget itself, or the coronavirus threats, all of which elevated in the last 2 weeks of January. But as that cools off, I think they should once again start cutting those shorts, which is what we'll be watching out for in the next couple of weeks. So I think that's all I'll put out in this update. The long short report for this month should most probably be published in the next day or two, once the markets confirm what I've been talking out in the early part of this video. And as that happens, then I'll put out a more detailed note in terms of what levels and where we are headed in the next couple of months. So that's all from me today. Thank you.